right. Good morning, everybody. I can see a lot of people are still logging in, but we are going to get started. It's 11 o'clock. So hope everyone's having a good day so far. I want to introduce myself. My name is Michael Bernier. I'm a certified financial planner with Cantor Wealth in La Jolla, San Diego, California. And I'm joined by another great CFP, Jim Mellon. Jim and I work closely with clients on a lot of things, but one thing that we specialize in is helping people produce tax efficient retirement income. We really have a pretty big focus on tax planning, really because it's something that we have control over. It might not feel like we have control over it, and as we go through today's webinar, there's still a lot, of course, question marks. We don't know exactly what's going to occur as part of the Biden or the current administration tax changes, but at least we wanted to start looking at it in the beginning of the year so that, if there is any applicable planning that people can at least start thinking about it, as opposed to potentially seeing, some major tax law changes later in the year and not necessarily having a lot of time to implement certain strategies that may make sense in 2021 before, a lot of these may come into effect. So, Jim, I don't know if you want to introduce yourself a little beyond that, or if anything else you wanted to say before we jump into it.
Yeah, Michael, it's good to be with you. Excited for today's webinar. And really, ultimately, the purpose of today's webinar is to get a better understanding of the current landscape, not only from a legislative perspective, but importantly, with a big focus on taxes, with the current legislative environment being much more favorable to actually enact legislation with a Democratic Congress and a Democratic president, with Kamala Harris being the deciding vote in the Senate. It makes some of these changes much more probable. And so we really wanted to make sure that everybody was aware of these changes, as you said.
Yeah, and there's been a lot of talk about it. I know on, any campaign trail or, every 4 years or so, taxes is a big point of conversation, and whether it's, Democratic controlled, Republican control, taxes is always a big topic. And I think, if you look at, where we're at, I've thought, and I think, Jim, you're like-minded, and we're not alone, but, over time, it's been likely, for a long time now that taxes are likely to go up. If you look at, even some of the current tax brackets that we'll get into in the beginning of this presentation, if you go back, there was a 30-year period of time following World War II where the highest tax rate was over 70%. There was a period of time it was 90%, and then really in the early 80s, and then, until now, tax rates have slowly come down. There's been a couple changes, here and there where they have come up some. But, with what we're looking at, I think, and I've been saying this the last, 15 years or so, that there's planning that people probably want to look at. Actually, regardless of, some of these changes that we're discussing, if you just look into the future and look at where, potentially tax rates could go, I think there's some good planning opportunities for folks, even without some of these potential changes. So, yeah, like you said, we wanted to jump in, at least go through what we know as of now so that people can at least wrap their minds around that. None of this has been implemented, or put into law, but at least we can discuss, some of those potential changes. And if those changes do come through, then how folks might want to, potentially plan for that. My gut feel, I know, Jim, you and I didn't talk about this, but we're probably looking at the second half of this year before we would see any, major legislation go through. I think obviously the big focus right now is, the COVID pandemic, rolling the vaccine out, but there is, definitely some things that are on the table here tax-wise. So let's jump into it. All right. So, Jim, what I thought would be good is, maybe you can let everyone know, kind of walk them through what tax structure we have currently, and when it comes to income tax brackets, what potential changes are getting thrown out there.
Yeah, so just a little bit of a refresher on our tax system. It is a marginal tax system, which means each dollar gets treated differently depending on the amount of income that you bring in. And Joe Biden's tax plan is a progressive system. And what that means is lower taxes for lower income families and individuals, and higher taxes for those that bring in higher amounts of income. And the centerpiece of his proposed legislation is that he won't change taxes or income tax brackets for those that fall underneath $400,000. He would increase the top marginal tax bracket by 2.6%, raising it from 37% to 39.6%. It's not just about raising the top marginal bracket, but it's also importantly about lowering the threshold in which that top marginal bracket begins to take effect. If we go back to 2017, pre-Tax Cuts and Jobs Act, single families that brought in $400,000 were still comfortably away from that top marginal bracket and didn't hit that top marginal bracket before getting to about $418,000. And for married filing jointly, you had until about $470,000 to before you reach that top marginal income tax bracket. And so almost, we're 4 years later now, and that top bracket threshold has been lowered. And so I think that's an important element of this legislation. And for those that fall into that top bracket, not only because of the increase in the marginal tax brackets, but also because, and we'll get into this later, the deductions and the shift in some of his other tax plan versus the current code, you could see your after-tax income drop by as much as 18%, and that's brought to us by the Penn Wharton budget model. So I think that all of these combinations of elements of his tax plan coming into play are important to note.
Yeah, there's several. I mean, we'll get into some of them today. But there's several. It seems like they've drawn that line in the sand at that $400,000 level. Not just for the brackets themselves, but for some other changes. So, kind of just take a step back while we're on this screen here. If I just get this pointer out, we are, like Jim had said, so there's no changes. We're not necessarily, we are in a progressive tax system or a marginal tax bracket system. So just to point out, to follow up on what Jim was talking about here, married filing joint. And so then this is showing sort of the brackets. And so there's the 10% bracket, 12, 22, 24, 32. And then this is where those potential changes start occurring, is above that 32% bracket of making it, then 39.6% tax bracket. So, if folks want to determine what tax bracket they're in now, I think now is a great time to be looking at tax planning as well, only because we're getting ready to prepare our 2020 tax return. And so whether you're looking at your 2020 return, if you have that completed, or even looking at 2019, because the numbers were fairly similar, this is all based on taxable income. Right, so taxable income after itemized deductions, standard deductions, any other above the line deductions. So if you look at that number and some of the figures that Jim was throwing out, that's how you then determine what tax bracket you're in. Now here we're showing married filing joint, we're showing individual. And of course, there's married filing separately, there's head of household. But at least to walk you through conceptually of what some of those proposals are in terms of changing the ordinary income tax brackets. That's what we're seeing at this point, right?
Yep, and one other thing to add there, if you note on the married filing jointly, right where your cursor is, you'll see that the 35% bracket has been completely eliminated. And so for those of us that are married filing jointly that fell into that 35% threshold for your top marginal income tax bracket, you could see a relatively high increase.
Yeah, absolutely. So now, with something like this, it's only going to affect really those over that $400,000 level. But, it's not just tax brackets, right? Because if we look at, even prior to, the end of 2017 or what became effective in 2018 with the tax cuts, okay, well, all of these did come down some, right? We don't need to go into what then was before that. But, it used to go from 10 to 15 to 25, 28. So all the rates came down a little bit, and now we might see on those upper ends, some of those rates go up some, but, we also want to make sure we're looking at deductions, because there are some, and we'll touch on it, but itemized deductions that we lost a couple of years ago, or that got capped. But one that, has affected business owners is, is looking at a qualified business deduction. Or was there anything that you wanted to touch on this one here? Before we get into what changes there might be on the QBI deduction?
Yeah, absolutely. So, the QBI deduction is something for pass-through entities S corporations, sole proprietorships, small business owners that now get a 20% reduction of their income on their business income. And so ultimately only paying 80% of their income, of tax on their income. So that threshold, if you were a specified service trade or business, and what that means is if you were a small business owner that wasn't creating jobs, you were capped at, $426,000 of income before you were totally phased out of this benefit. For small business owners that weren't classified as a specified service trade or business, regardless of your income, you got this benefit of reducing your business income by 20%.
Right. And that was a huge benefit. I know for some of my clients that, are small business owners, having this basically, just to simplify it, it is pass-through entities and all that. But, if you have a business that qualifies, an extra 20% deduction, definitely didn't hurt. Right. So that's really what this chart's showing is, based on what someone's marginal tax rate might be, if they were able to take advantage of that qualified business income deduction, it effectively reduced their overall effective rate, right?
Absolutely. And the new proposal completely phases out at $400,000 of income. And so, that $400,000 of income, let's say that, you had $300,000 of business income, but you had, $150,000 of gains or, other type of income like portfolio income, because on the tax return, your income would represent above $400,000, even if your business income was underneath that threshold. That benefit of this 20% reduction is now gone. It does not apply to you anymore. And so from a planning perspective, it certainly represents a lot of challenges and a lot of moving parts. And I think it's just really important to not look at just one element of your finances in a silo. Every element from a financial planning perspective is connected. And so I think you and I both work together with clients on trying to bring all those moving parts together.
Yeah, no, absolutely. And, as we're going through this, we've got a short period of time together, right? An hour to go through, at least high level, just, brush over some of these and at least make everyone aware of what's being proposed. We are going to save some time at the end. If you do have any questions, I know with some of this, like Jim just said, right, you kind of got to look at everything, to be able to answer potentially certain questions. But if anyone does have any questions, at the bottom of the screen, there's a chat box. You feel free to put in a question there, or there's also a Q&A button that you can click. So, I'll keep track of those as we go through. And I have seen somebody already, may have some questions. If it applies to what we're going through at that time, I'll try to get to it, but we'll also leave, about 10 minutes at the end to go through some of the questions that we can. So what about itemized deductions? Because I think, with a lot of, what we went through, okay, if you're over that $400,000 level for that QBI deduction, if you're over 400,000, we could see some changes in terms of the ordinary income tax brackets. But for those higher income earners, there's also some big changes potentially on itemized deductions. And maybe you could explain, Jim, that cap on itemization at 28%. What does that mean?
Yeah, absolutely. So a good way to think about this is if your marginal bracket is above the 28% threshold and you itemize, this can have a significant effect in your effective tax rate. Deductions for high income earners have a greater value versus folks that are in the lower tax bracket. So 32, 35, 37, and even potentially the 39.6% top marginal bracket. If you do itemize, the spirit of this rule is that those folks were getting greater value from their deductions. Some of the ways that this mechanically gets put into place for folks that do itemize, let's just think about charitable contributions for an example. So if I'm in the 39.6% tax bracket and I want to give $5,000 to charity, for example, well, that $5,000 of earned income is going to be charged at 39.6%, creating a tax bill of about $1,980, and I'm going to get a cap on those deductions at 28%, which means I'm only going to get $1,400 towards that charitable contribution. So ultimately what that leaves you with is almost a $600 tax bill on funds that you no longer have.
Right.
And so what is also important to note in my view is that while charitable deductions are certainly the most glaring and maybe the low-hanging fruit, this also affects mortgage interest deductions, healthcare deductions. And so it's just attempting to level the playing field, because the more that your income, the higher your income, the greater the value of those deductions. And so that's the spirit of what they're trying to enact.
Yeah, sorry, I didn't mean to interrupt you, but yeah, let's just like break that down. I mean, when we look at itemized deductions, if we kind of go back to what those are, there are medical deductions, right? You've already have to cross certain thresholds to be able to actually deduct them. There's state taxes, property taxes, personal property taxes. Now we'll get into in a second. There's been a cap now for the last couple of years on that, but also mortgage interest, as well as then charitable contributions. So, if I just use maybe, another example to illustrate that, it is, Biden has said, that people in those higher income tax brackets are getting, much more bang for their buck on their deductions. So let's use an example where someone has $10,000. Now that wouldn't actually qualify you to have, or to actually itemize, but let's say round number, $10,000 of itemized deductions. And if I'm in the 12% tax bracket, that saves me $1,200. Right, if I had $10,000 of itemized deductions and I'm in the 35% tax bracket, that saves me $3,500 in taxes. Right, so now, if I am in that, like we've listed here, 32, 35, or 37, or what could be the 39.6% tax bracket, well, then the maximum value I'm going to get in my example with 10,000 of itemized deductions would be $2,800, regardless of what comprises that $10,000 in itemized deductions, right?
Absolutely. Yep.
Now on the positive side, because I know so far, things are increasing, maybe caps on, itemized deductions, but, back in 2018, when there was, well, at the end of 2017, but implemented for 2018, there's also been a cap, just like I had, touched on state and local taxes. So that for a lot of people, even though in 2018, all the income or most of the income tax rates came down a little bit, taking away certain deductions or capping certain deductions, caused at least a lot of people that I work with, maybe not to pay a significant amount more or save a significant amount, but, to cause them to pay about the same in tax. So prior to 2018, you could fully deduct the state income taxes that you pay, the property taxes that you pay, and personal property taxes like DMV fees. And so starting in 2018, those were then capped at $10,000. So the people that were really affected more, by that were people, let's say, where we're at in California, where, we pay a good amount of state tax. We've got, high property taxes. So to cap that at $10,000, really did take a good amount of deductions away, in 2018, where there has been a lot more talk, and there's been talk really over the last couple of years even, but, of removing that and repealing that, which, on the positive front, allowing those, especially in higher income tax states, to have more deductions, that could definitely be, one of the positives that we see come from this. And then also, maybe we don't spend a lot of time here because I want to make sure that we get into, some of the more pressing planning opportunities, at least in my mind. But maybe, Jim, you can go through some of the changes on tax credits that have been proposed.
Yeah, absolutely. So, there's the child tax credit, and the current environment says $2,000 per child and $6,000 for 2 or more children. And they're slated to increase that credit to $3,600 for children under 6 and $3,000 for children up to 17. You have the child independent care credit, currently $3,000 per child under 17, and they are looking to increase this credit to be refundable, importantly, and up to $8,000 for 1 child and $16,000 for 2 children or more. And so, that's some pretty substantial changes from the current environment. There's also the first-time homebuyer credit, which is refundable and advanceable up to $15,000 or 10% of the home's purchase price. whichever, it caps out at 10% of the home's purchase price. And there's still some foggy details around how they would actually enact this, but they want folks that are purchasing houses for the first time to have access to those dollars before April of next year.
Yeah,
there's also the care. Oh yeah,
sorry,
absolutely.
Just to jump in real quick, Jim. A refundable credit, just for those that are unaware, that's just one that doesn't just drive your taxes down to zero. You actually can, let's say I had $10,000 in taxes due and I had the first time home buyer credit of $15,000. If it is refundable, I could get a refund of $5,000.
Yes, well said. And the caregiver credit, if you are helping to provide informal care to folks that are in need of long-term care, you can get a credit of $5,000 against your taxes. This one is not set to be refundable, but can certainly be helpful. And then, of course, green energy is a big push for the Biden administration to reinstate or expand tax incentives to reduce carbon emissions, electric vehicles, investment in commercial or residential property, and then, to eliminate deductions federally for oil and gas drilling costs and depletion.
Yeah. Yeah, no, and so there's definitely, there's some good opportunities if some of those are applicable. But, when we start talking about credits, what's interesting, and I think will impact a lot of the planning that we do with folks, is this retirement contribution credit. So I want you, Jim, to kind of go through what that is, but let me real quick just start with, let's see. All right, I just kind of want to draw this out so people understand how, retirement accounts currently have benefits either going in or coming out. So, just to put it simply, let's see here. All right, so let's just say I've got these two different pools. Let me do this real quick. I'm just going to give myself a little more room. All right. So we have two different pools in terms of retirement accounts where we can have our money saved. This one up here, I'm just going to refer to as tax-free, and then down here, tax deferred. So a tax-free, account, let's say Roth IRA, for today, I don't get any benefit putting money into a Roth, right? So I'm taking after-tax money, or it could be a Roth 401k. That'll kind of, I guess, come more into our conversation today. So if it's a Roth IRA, Roth 401k, I do not get any tax benefit putting that money into the Roth, but then all that future growth, as it's defined, right, tax-free, is 100% tax-free. So no benefit going in, all the benefits on the principal and all the growth, then being tax-free. And then over here, tax deferred, this would be, let's say, our 401ks, depending on, the type of employer I have, could be a 403B if I'm a school teacher, 457, TSP if I'm a government employee, just all the types of retirement plans that would fall into a tax deferred environment. And so on these types of plans, and right now I'm just talking about how it is currently, well, as I put money into my 401k, I'm reducing my taxable, or I'm reducing my income, right? So if I make $125,000 and I put $25,000 into my tax deferred 401k or traditional 401k, then my income is going to show $100,000, right? It's right off the top, it's pre-tax, and then whatever tax bracket I'm in. So let's say, I'm in the 35% tax bracket. Well, if I put in, now I'm going to go back to that easy $10,000 example. If I put in $10,000 into my 401k and I'm in the 35% tax bracket, that's going to save me $3,500 in taxes. Or to go back to what I was using earlier for itemized deductions, if I'm in the 12% tax bracket, that $10,000 into my tax deferred 401k is going to save me $1,200. All right, so kind of going back to the way you've worded it, Jim, there's been a lot of talk about evening the playing field there and, not having so much benefit go towards those in higher income tax brackets contributing to their plans. And so going in, like I said, right now, that's when we get the tax benefit, but then coming out, well, then I'm going to pay ordinary income, right? So whatever tax bracket I'm in at the time in the future, that's how those withdrawals are going to get taxed. So that's where this change comes in, where the idea would still be the same in terms of how the money on the way out is treated. Again, I put after-tax money into a Roth. And if it's a Roth IRA or 401k or even traditional 401ks or IRAs, there's different income thresholds. You have to have earned income. So, a lot of what we're going through today is real high level, but hopefully you get a couple things that, make sense to look into, but there are certain limits that you want to be aware of. But it's important to understand that Roth benefit not going in, but all the benefits on the way out. 401ks or tax deferred plans, as I put money in, I save money in taxes, but then it's all going to get taxed on the way out, which then, comes to some of these changes. And I don't know if you have anything there, Jim, that you wanted to add before we jump into the change with the retirement credit.
I think you did well in explaining it. And so just some background on this 26% number. Ultimately, this is from a, unbiased third party, the Tax Policy Center. And, what they were aiming at is a revenue neutral tax credit on pre-tax savings. And so in that tax deferred bubble that Michael just drew for us, that's all pre-tax savings that, as Michael said, comes out at ordinary income when you withdraw. And so this 26% number is arbitrary at this point. So we're still unclear on what the credit will be, but we'll stick with this 26% number for this discussion. And so, just to use Michael's example of being in the 35% or in the 12%, well, if I save pre-tax in the 12% bracket at a $10,000 level, I'm getting about $1,200 of a tax benefit there. If I save that same $10,000 at a 35% level, as Michael said, I get a $3,500 tax benefit. For those that fall into the higher income thresholds, good way to think about it, same way as itemization. If my marginal bracket is above that 26% credit, well, now I have to ask myself, am I incentivized to continue saving the way that I was saving in the past? And the answer is no, you're not incentivized to do so. And so ultimately what it does is it flips the traditional way to think about retirement savings on its head. If I'm younger or in a lower income bracket, I'd want to save in a Roth because the benefits of saving pre-tax, really aren't that substantial for me. And ultimately having the money withdrawn at tax-free rate is more beneficial for me. But if I'm in that 12% bracket, instead of getting on my $10,000 contribution $1,200, I now get a $2,600 savings on that, more than doubling the benefit to save pre-tax. Conversely, if I'm in a higher income tax bracket, and we'll just use 35% as the number there, well, yes, I get a 26% credit on my $10,000 contribution, but ultimately the spread between 26% and 35% is 9%. And so I'm effectively charged 9% on my pre-tax savings, and that's only on the incoming contribution. Talking about now the mechanics of a withdrawal in the future, and just to keep it easy, let's just say that we have a lower income tax liability, but still we're in a top bracket of, let's just say 32%. Well, if I add the 9% that was taxed on my contribution, and then I get taxed at ordinary income on the withdrawal, well, now my effective rate has been 39% for my entire savings of that particular contribution, and that's only federal. When we talk about state, because the retirement contribution is going to fall into your adjusted gross income, I'm now charged on the contribution at full state tax in my marginal bracket, wherever you fall. And then on withdrawals, I'm also going to be charged. And so it kind of makes it very, you're no longer incentivized if you are above that, arbitrary, in today's discussion, a 26% credit. If you're
right
above that threshold, you really have to ask yourself if you're incentivized to save pre-tax.
Yeah, and if you're not, then, part of the strategy could be, is then, okay, especially if I have, let's say, a 401k that has a Roth component, right? If I, within my 401k, can go Roth 401k where it's after tax money, I don't get any tax benefit on the way in, but then it's all tax free on the way out, or I can go traditional 401k, which is what you were describing as well. Then if I'm in those higher income tax brackets, even though I might be biting the bullet and paying extra taxes and missing out, let's say, on this 26% credit, well, it might make sense to go into the Roth 401k because of that watered down benefit, for someone like that. And then, like you had said too, if I'm in a really low income tax bracket, I've always given the same advice that you said is, well, if you're putting money into a 401k and you're only in the 12% tax bracket, are you really getting that much of a tax benefit? Maybe go Roth 401k, or maybe save outside of retirement accounts. But yeah, that could, completely switch it up to where, just kind of summarizing it, right? If you're in lower income tax brackets, you're going to get more bang for your buck going into a 401k and getting this 26% credit, so you might continue to do that, whereas if you're in higher income, maybe you do start saving post-tax Roth 401k or looking at other options. And you said this too, Jim, but yeah, I've seen, this is the most popular number that's been thrown around, 26%, but that concept of a credit would definitely change things in terms of how people are saving into their retirement
Yeah,
plans.
absolutely.
Then capital gains. Let's get into this because this is a big one, for investments, right? So, whether it be stocks and bonds, mutual funds, traditional, liquid investment accounts like that, or real estate, there could be some potentially big changes. Now there is a certain income threshold, but maybe you can describe what's been thrown out there in terms of long-term capital gains and how their treatment could get changed.
So while the Biden tax plan has designated $400,000 as their income threshold, over in long-term capital gains land, $1 million has been earmarked. Let's just look at our example here. So if an individual has $250,000 of wages and sells an investment property for a gain of $750,000, all other dividend and investment income would be treated at ordinary rates. And in this case, it would be the 39.6% top marginal rate plus the 3.8% surtax on investment income. To better understand the current environment, just backpedaling, the top rate for long-term capital gains is 20% plus that 3.8% surtax on investment income. And so for those of us that are entertaining selling investment properties or are going to have substantial gains in their portfolios, the top rate has nearly doubled, almost 20% higher, from a top rate currently of 23.8% to a potential rate of 43.4%. And to be clear, in our example, the $750,000 of gains in this example would be taxed at long-term capital gains, and then any additional investment income that were held for over a year. And as you know, Michael, long-term capital gains means you've held your investment for over 1 year. Any additional investment gains from that point forward would then be taxed at the top rate.
Yeah, no, I mean, that's a huge change. And I think definitely something, for myself and some of my clients where this applies, keeping an eye on that, throughout the rest of the year, because, if I do have some significant gains, whether it be a rental property, we're going to get into, step up in basis and, potential changes, on that front, estate taxes, but if I do have some sort of capital investment that I do plan on selling, it might be, a good year to look at doing that, only if it's on my agenda anyhow, and I'm in some of these higher brackets, that's going to be a pretty substantial, increase. And, also qualified dividends. So, what's nice, and we don't need to go too deep into it, but, qualified dividends, have also been treated like long-term capital gains, in the recent past. And so that also gets, added on here if you're above that $1 million income level. Anything else you wanted to touch on there?
Just briefly, if you are flirting with these thresholds and you do have significant gains, putting a budget on, how much in gains that you harvest each year is, certainly now got its magnifying glass over it. And so just being extremely detail oriented about, what's being reported and where you're at in terms of your capital gains budget each year, if you are in this select few.
Yeah, absolutely. All right, real estate. So there's several different proposals getting thrown around on the real estate side. And I mean, real estate, we talked about it, down here, it actually says the elimination of the QBI deductions, for real estate investors. That could be a big one, right? In the beginning, we were talking about that extra 20% deduction, and, real estate as a business, also qualified for that. So that could, potentially be eliminated, or at the very least, have those income thresholds to where it completely gets phased out. But right up here, the first bullet point, eliminating $25,000 passive loss exemption. So right now, just to give you a little bit of background, like let's use a rental property, or maybe I have a couple rental properties as an example, with my expenses, with my depreciation tax write-offs. If I'm generating a loss and I'm not a real estate professional, so if I'm a real estate professional, I can take those losses, and there's certain qualifications for that. But if I have income, modified adjusted gross income under $100,000, if I have losses of $25,000 or more, under the current law, is I get to at least take that $25,000 of losses. Now, even under the current law, if I have $45,000 of losses, and again, I'm not a real estate professional, and that's what's generating those losses, I'm still going to get capped at the 25, and I'm not losing it. It's just the other $20,000 in that example carries over as a passive loss carryover. Until then, I either have the income to offset that, or I end up having a total disposition of a property. So if it's under $100,000, currently I can take that $25,000 loss, or up to that if I have that. Now, as my income goes up, my modified adjusted gross income, after it goes over $150,000, that $25,000 is completely phased out. Right, so under 100 grand, I can take the full 25 if I have it. Over 150, I don't get to take any of that, but same idea, it's just going to carry over as a passive loss carryover. And if I'm between 100 and 150, it's what they call a phase out. So they start taking that away. Where here, they are just looking at eliminating that. I can only imagine that it would be the same scenario, that you're going to carry it over until you have passive gains or passive income to then offset that, but they are looking at potentially just taking that away. Now, if they did that, though, I would also still imagine that if I am a real estate professional and I qualify for that, I'm still going to be able to take those losses. But this would be a way where they're limiting some of those passive losses that middle income individuals are taking. And then I think another big one is eliminating 1031 exchanges. So a 1031 exchange is the ability to defer tax on, let's say, property. So if I bought a rental property for $100,000, now it's worth $1 million. Let's say I'm not thrilled with holding that property anymore. I want to get rid of it, but I have $900,000 of capital gains, so that might, just have me hold on to it, or I guess I could just sell it and pay the taxes. But a lot of people, if they want to make a change, they can elect a 1031 exchange where they can sell that property and defer, in my example, that $900,000 into another rental property. So it does have to be investment property to investment property, and you are just deferring it. Now, after death, there's a step up in basis, but while you're alive, you are just kicking the can. You're deferring those taxes. There's a lot of requirements for a 1031 exchange in terms of how you go about doing it. You have to use a qualified intermediary. You have a certain time period, to identify properties and then actually close on the properties. But that has been a way, for people to be able to sell a property, defer maybe into something larger, more, structured for cash flow as they get closer to retirement. But they have talked about eliminating 1031 exchanges and the ability to do that, which, to me would be, a pretty big deal. I'm going to come back to this next line, the eliminate rules for accelerated depreciation. But, on 1031 exchanges, Jim, maybe you can touch on, and it's super unclear. I've read it in a few spots, but, the elimination has been proposed with people over a certain amount of income.
Yeah, absolutely. So the rules are still relatively vague about how they would actually enact this in practicality. Hey, if I have, $250,000 of wages, but, I'd like to sell my investment property and then subsequently purchase a like kind property, does that sale and subsequent purchase represent taxable events? And so, for folks that are real estate investors, especially in today's market, it's going to be challenging to keep yourself with income underneath that $400,000 level if you are looking to execute a 1031 exchange. And so the elimination of the elimination of a 1031 exchange for those with incomes over 400,000 would represent significant challenges from a tax perspective.
Yeah, no, absolutely. And I mean, it's my guess, so take it for what it's worth. But I feel like if this was to come to fruition, that it would not include the capital gain. That my ordinary income would have to be 400,000 or higher before they would completely eliminate that. Maybe we're a little biased because we live in Southern California, right? But I mean, if you even had an average income, then throw in, hey, I had this rental property and I've got a $500,000 gain. If that bumps you over, the inability to do that, I think would, I think it's unlikely, but, again, we will see.
I would agree. And just briefly, the spirit of this progressive tax system is to, really put a magnifying glass over the top earners in this country. And I think that, 1031 exchanges are more mainstream. And so I would agree with your previous statement. Yeah, no, I mean,
I was involved in quite a few 1031 exchanges, in the early to 2000 2005 timeframe. And yeah, I wasn't, at least from my experience, I wasn't working with these giant corporations or people just with an absorbent amount of money. It was a lot of people looking at trying to get out or reduce maybe management on properties that they've held for a long time. And it was your millionaire next door, especially like I said, in areas like San Diego, where real estate properties are so high. So let's get into, so we had talked about like deferring, right, the taxes, but there is, I alluded to it, right, there's a step up in basis. And I think that's also when we look long-term at planning for our clients or for ourselves, this along with the estate tax changes, I think is a pretty big deal. So maybe Jim, what are they proposing on the elimination of the step up in basis? Or maybe just start with, what is the step up in basis currently?
Absolutely. So if I were to pass away and I had after-tax assets, this wouldn't apply to pre-tax assets. Pre-tax assets don't have a cost basis or what I purchased them for, because the government really cares only about the distribution of those assets when they do get to claim the tax upon them. So for after-tax assets, if I purchase something at, if I have a cost basis or what I purchased an investment for, let's say it's $500,000, and when I pass away, it's worth $1 million now. Well, the folks that I pass those assets down to now get the fair market value of that asset on the date of my passing. And so they no longer have, in my example, to pay the $500,000 of tax on the investment gain. The spirit of this rule is, ultimately, it wasn't necessarily meant to be a tax break per se. It was really meant to say, well, in practicality, in folks that are beneficiaries, many times didn't know what, I would have purchased that asset for. And so they didn't know the cost basis. And so from a practical perspective, I wouldn't also be around to let you know how much I purchased those assets for. So, from a practical perspective, it was more about ease, more than a tax break. And, I think that the implementation, Michael, would you like to speak to the implementation of what they're proposing?
Well, yeah, well, and like you said, I mean, a lot of it when it comes to like individual stocks, I mean, I'm sure you have too, but I've, run into clients, maybe their parents, where it's all that, they bought AT&T for some small amount. It's kept track of in a little black book, a little spreadsheet that, mom or grandma, has kept track of. So yeah, to be practical, that was just eliminating that issue after somebody died, right? Totally just step up the basis, date of death value, that's your new tax basis, kept it pretty easy. And, also, with real estate, I guess, where I would jump is if we look at, I'm going to come right back to that, but like federal estate tax exclusion, when we talk about estates being large enough to then have an estate tax, especially now, and this number has definitely, been creeping up, over the last 10, 15 years. But, I can pass $11.5 million to my heirs, free of any estate tax. If I'm married, it's going to be twice that number. And estate tax exemptions, or the exclusion, and capital gains are sort of tied together. So like in 2010, there was no estate tax, right? So in 2009, I believe the exclusion was about 3.5 million, and then if nobody did anything, it then went away. And in 2010, it did go away. So, it's kind of morbid, it said that was a good year, I guess, if you had a giant estate, and if you were going to die, that was a good year to die because there was not an estate tax. But at the same time, it's tied into that step up in basis where, in 2010, there was also a limited step up in basis. So yes, there was no estate tax, but, then they did limit, it wasn't completely done away with, but there really wasn't much in terms of a step up in basis on very, very large assets. So when you look at like this estate tax exclusion, a very small percentage of the population, does this apply to. Right? If it's a married couple over $25 million. But when you talk about the step up in basis and, tax consequences of inheriting a property, I mean, from my experience, I think that applies to a lot of people, and maybe it's just one asset. Let's say I'm married and I inherit, my mom's home. It's the home I grew up in, and well, I'm not going to live in it. Maybe it's in a different area, and I need to sell it. Well, now without a step up in basis, I might have a significant tax consequence, which, I mean, first of all, I think will change my probably opinion or my game plan. To where I think right now, as somebody passes away and you inherit a property, you could sell it free of any taxes, and just move on. But, if there's still that embedded tax, I think, we'd probably see a reduction in, the amount of homes being sold or properties after death. So I think, yeah, that would be an interesting one. I feel like maybe similar to 2010, maybe they put a cap on it, to where if they really are targeting those with super high income, maybe having a step up in basis that, might be, you get $1 million, right? So whether it's stocks, bonds, real estate, you get $1 million step up in basis. Anything above that, you don't get. But it'll be pretty interesting to see where they take that one.
Yeah, I agree. And I think you touched on sentimental assets, inheriting a property from, your parents. And, goodness, if we think about, if I'm forced to pay taxes on the assets that I inherit that are after tax, let's talk about illiquid assets. What about family businesses, for example? How do heirs come up with that liquidity? And so that can represent a lot of challenges. And, goodness, it's been a little bit of dour news potentially here for some folks. And so the silver lining here is that with this particular element of Biden's plan, this has come up in the last 50 years twice, and both times have failed. And so I think that, and you mentioned it earlier, this would affect a lot of people and would not necessarily align with the progressive tax system that, Joe Biden is certainly trying to push forward. I think this would be a real challenge for a lot of people in America. And so, I think that the likelihood that the political will exists out there to push this through is relatively low.
Yeah, no, I agree. I mean, I think, we have enjoyed this step up in basis, for a long time, and I think it does affect a lot more people. If I had to guess, I could easily see, the current, lifetime exclusion amount going down, right? And that number's been all over the place, right? I referenced, really wasn't that long ago, and, it's tough. Like now, time flies by, right? But if you look at, like in the 90s, early 2000s, there was a period of time where the estate tax exclusion was like $600,000 a piece, right? To where, if I lived, let's say, in San Diego, I own my home, maybe a rental property, or, I've built up some assets, like, state taxes definitely applied to quite a few people. And so that's where, then you wanted to make sure you had an A and a B trust to take advantage of, as much as you could. Well, then, like I said a little bit ago, 2009, it was 3.5 million. Right, went away in 2010. Then it was set to go back to $1 million, got bumped up to 5 million, and then now we're at $11.5 million a piece. So I think somewhere in that if you look at the middle range of at least what I'm reading, $3.5 to $5 million a piece. And then, having this estate tax, which is a, pretty decent rate, and that rate, changes quite a bit too, but, it can be anywhere from 40, 50%. I mean, it's fluctuated over the years, but it's a significant tax. So I think they would reduce that before completely eliminating the step up in basis. But, definitely when it comes to estate planning, something to be aware of not only how it might affect me during my life, but then, where I've planned on passing those assets on tax-free to my heirs, something to be aware of as well. So, so then Social Security. So right now, with Social Security, there's, been some changes, and there's been a lot of talk about this. Now we're just starting to at least see maybe some sort of game plan on how to best go about it. But, the bottom line is that Social Security is underfunded, right? I mean, depending on what you're reading, like, Jim, you and I were talking about yesterday, like in 2030 something, it's estimated that only 75% of the benefits going out of Social Security, or benefits being paid in Social Security, enough money would be going in. And if you look at the issue, I think if you go back to when Social Security was first introduced, we were looking at like 42 people paying into Social Security for every one person taking it. Well, now it's not anywhere near that. I think it's like 3 to 1. And so, a huge part of our population is now receiving Social Security benefits. And so to see that it's potentially underfunded, I've been of the opinion for a long time that, I mean, right now they do have the cap on income go up. So what this is referencing right here, 12.4% with a cap at 142, is depending on my income. So in this case, if I make more than $142,000, anything above that, I no longer pay Social Security tax on. Now, I still pay Medicare, as part of that, but the Social Security portion goes away, in this case, once I'm above 142. Now, that number has gone up. It was only a few years ago. I think it was 125, went up to 130. And when we talk about issues with Social Security and being underfunded, a lot of people have agreed that that cap, would get raised, and that would provide more funding to Social Security. Well, now we go back to that $400,000, figure that gets thrown out a lot. So what this is saying is, as it is now, or traditionally, you'd still pay, full Social Security tax. And it's worth noting the 12.4, that's the employee and the employer side. So if I'm self-employed, I pay both sides, but as the employee, I pay the 6.2%. So you'd still pay the 6.2% as an employee all the way up to $142,000 in income. And then there'll be this period of time that then I still won't pay Social Security tax, but then having that go back into effect at $400,000. So if I'm making $1 million, then it's going to be that extra $600,000 where I have that additional Social Security tax. I think that's likely. Most of our clients are retired or near retirement. And so, there's always some concern over Social Security, and can we rely on it? Is it going to be there? And who knows? We don't know for sure. But there will be changes, and I think it's important to know that there's been changes historically. Prior to the early 80s, you didn't pay tax on any of your Social Security benefits. Now you can pay up to 85%. So, I've been of the opinion for a while that it might not be big changes on the benefits being paid out, unless they're changing it for people maybe in their 20s or 30s. But I think it's more of a, funding issue. And that's what, this would address, is getting more money into that program. Whether or not it's popular, amongst those that are making more than $400,000. And then I think the other big one, and I know I wanted to save a little time for a couple questions that we had come in, but Jim, maybe just touch on, because I think that this is a biggie, and I think it's probably pretty likely to some degree, but some of the changes on corporate tax rates.
Sure. So the current environment is a flat 21% on corporate taxes, and Joe Biden is planning on raising this to a 28% tax. And, the spirit of this is 91 out of the 500 Fortune 500 companies paid $0 in federal income tax. And so this is an attempt to curtail that. There would be a new minimum tax as corporations, quote unquote, try to race to the floor on their tax return. There would be a new minimum tax of 15% on book income. And so there would be a mechanism there to have corporations pay some income tax, regardless of what other deductions they have on the ledger. There would also be a tax penalty on corporations that moved operations overseas, and then went back and sold their goods to Americans. And so, a lot of moving parts here from a corporate perspective, whether it's the QBI deduction or the increase in your, ultimate tax rate. So there's a lot of moving parts here when it comes to corporations and the way that they're going through the tax environment.
Yeah. And if we look, this has been one that's, gone back and forth, over the last several years, in the, Obama administration, corporate tax rates were even higher, than what, Biden at least is proposing. And I think there is a lot of uncertainty on whether or not it'll be 28% or not. Currently, as you got listed here on the slide, it's a flat 21%. So, I think seeing some increase there, is probably likely. And, on that point of, people moving, overseas, and putting their headquarters out there, like that's one that, I want to keep an eye on too. I think that'll have a potentially a pretty big effect, of those international taxes as well. So, yeah, who knows? I know there's a lot of scrutiny on, large companies that don't pay any taxes, and so I think the big one would be interesting to see how they actually impose it, but, what that, 15%, minimum tax could be. But, of course, a lot of businesses would also just be affected by that corporate tax rate going up. All right.
And there's one thing quickly to add, there's broader implications here as well when it comes to increasing taxes on corporations. Does that now mean that, the average line worker has lower wages, or do you potentially have lower investment returns? And so there's some broader implications there as well.
Yeah, no, absolutely. And I think that, the biggest thing as we're going through this, Jim, is, there's just a lot of uncertainty, and obviously there's always something, right? There's always some uncertainty in the world. I'm saying it, kind of kiddingly, but what would be, keeps life interesting, right? And, it actually does. As I say that, I enjoy taxes. I know that might sound like a weird statement, to a lot of people, but it is an ever-changing law. And, unfortunately, I think a lot of people, like right now, we're all, getting our taxes prepared, whether we do it on our own or we're meeting with our CPA or enrolled agent tax preparer. So we're always just looking at the year behind us, right? And looking, okay, well, it's 2020 taxes that I'm preparing. What else can I do? And, maybe I can still do an IRA contribution, or maybe if I'm self-employed, I can contribute to my employer plan. But, good tax planning really is something that you want to be forward-looking, right? And, not even just with a lot of the changes that we went into here, but just looking at, okay, 2021, what's my tax situation? What does that look like in retirement? What planning should I be doing between now and then? And now especially with all these, potential tax changes, really looking forward and saying, okay, well, where am I at right now, tax-wise? Where, maybe including some of these changes, where would I be in the future to figure out what planning might be appropriate? And so, there were a couple of questions, but, I'll end up reaching out. One of them was, if you'll get a copy of the slides. We won't be sending the slides out, but everyone will receive a digital copy of the presentation. There are also many people that had requested to just receive that weren't able to make it. But one thing that, I wanted to throw out there is, just with everything going on, and unfortunately such a lack of education out there, we always offer a free financial checkup, for anyone that wants to take advantage of that, where, we're happy to sit down with you, get a good handle on your current situation, not just from taxes, but looking at overall retirement income planning, which a lot of times involves taxes, but where are you going to be drawing your income from in retirement? How much can you spend in retirement? Even without tax law changes, is there any tax planning that's appropriate now, or anything you should be implementing over the next several years? We don't prepare taxes, but that is tax planning is a big focus of ours. Looking at your investment portfolio and giving you some feedback, on risks that you're taking, maybe some changes that you might want to make. How is your portfolio currently being taxed? How might that change with some of these proposals? Talking about insurance, talking about estate planning. We want to get as much information out there as we can. And so if anyone wants to take advantage of that, we are going to send out an evaluation form after this. Even if you don't, if you could give us feedback, we would really appreciate it on, maybe some areas or questions that you have, and we could also, follow up with you. But on that evaluation form, it also has a spot to where if you do want to take advantage of that free financial checkup, by all means, check yes. We'll follow up with you and, get a meeting on the books to where we can really try to apply a lot of this to your situation, along with a lot of other planning strategies. But, if you don't want to take advantage of it, then by all means, just check no. We're not, here to hassle you. We just want to make sure that we get you as much information as we can. You know, an hour is a good amount of time in a lot of things, but to go through, you know, what could happen and how that applies to everyone, you know, is tough over such a short period. So, Jim, anything else before we wrap it up?
I think we covered it. It was nice to be with you, and we hope that everybody got a few takeaways from this presentation.
All right. Well, thanks, Jim. I appreciate it. This was fun chatting and sharing the information, at least we have at this point. But other than that, yeah, keep an eye out for that evaluation form. And if you can get that back to us no matter what, and again, if you want to take advantage of that free checkup, just let us know. But other than that, I hope everyone has a good rest of their day. And if you do want to attend any of our future webcasts, you can go to cantorwealth.com/webcasts. And we also have all of our archived webinars on there as well. So enjoy the rest of your day and take care. Bye.
Bye now.